Welcome back to lesson 2 of our supply and demand module. In this lesson, we will explore how a candle's shape and position reveal price imbalances, as well as how to categorize candles based on their form. You will also discover how to accurately place demand and supply zone lines on a chart by examining the different elements of a candle. Let's begin by looking at the 3 types of candles we use to identify supply and demand formations: indecisive, decisive, and explosive. Each one reflects a different dynamic in how buyers and sellers interact with the market. An indecisive candle is one where the candle's body is smaller than or equal to 50% of its total range, suggesting that neither buyers or sellers are fully in control. This often means the market is balanced or in an accumulation phase. By contrast, a decisive candle has a body that exceeds 50% of the total range. This is where either buyers or sellers have taken charge, creating a clear shift in momentum. Finally, explosive candles are an intensified form of decisive candles. The body covers more than 70% of the entire range, with minimal wicks. They tend to appear much larger than preceding candles. This kind of price action often signals a powerful imbalance in the market, usually driven by institutional orders, rapidly absorbing any opposing liquidity. When we relate these candle types back to supply and demand formation, we typically see indecisive candles in the base, indicating a period of balance, and explosive candles in the rally or drop away from that base, showing where one side has clearly overpowered the other. Recognizing these candle patterns helps us pinpoint areas of genuine supply or demand, so we can trade with greater conviction and align ourselves with the stronger side of the market. Here are a few examples of different candles. Take a moment to figure out their categories. Then let's walk through the answers together. The first candle is explosive because its body covers almost the entire range. Notice there's hardly any wick. Candle 9 also falls into the explosive category. Next, candle 2 features a large wick and a small body, which is less than 50% of the total range. So it's indecisive, just like candles 4, 6, and 10. Meanwhile, candles 3, 5, and 7 each have a body larger than 50% of the candle's range and fairly small wicks, marking them as decisive. Finally, candle 8 is a special type of indecisive candle, known as a pin bar, where there's virtually no body and almost the entire range is wicked. This is a signal for extreme balance between buyers and sellers, as the candle closed at the same price it opened, meaning neither side managed to gain control. Feel free to screenshot this cheat sheet so you can have a reference when looking at price charts later. Let's revisit the 4 zone formations from lesson 1 and examine how candle types shape each part. Every zone has 3 segments: a leg in, a base, and a leg out. In a demand zone, whether it's a drop base rally or a rally base rally, the drop or initially rally is your leg in. The middle portion is the base, and the final rally is the leg out. The leg out is the most important part of the zone because it results from an imbalance in the market. A stronger, more explosive leg out signals a higher probability that institutional buyers or sellers have forcefully pushed price away from the base. Ideally, you will see large candles with bodies covering at least 70% of their total range, indicating powerful momentum. Meanwhile, the base should feature indecisive candles, reflecting a moment of balance between buyers and sellers. As for the leg in, it typically has decisive candles, though it may include 1 or 2 explosive candles to show a clear, controlled entry into the zone before price settles into the base. Now let's apply the same structure to our 2 supply formations, the rally base drop and the drop base drop. In the rally base drop, which has an inverted U shape, you will see the rally as a leg in, the base as a middle segment, and the drop as a leg out. For the drop base drop, the initial drop serves as a leg in, the base remains the base, and the final drop is a leg out. As with demand formations, we assign the same candle categories. The leg in should include decisive or even explosive candles, showing a clear push into the zone. The base typically features indecisive candles, indicating a balance where neither buyers nor sellers dominate. And the leg out should be made up of explosive candles, suggesting strong institutional activity and implying that unfilled orders are likely present within the base. By matching these candle types to each part of the formation, we gain a clearer picture of market sentiment and can pinpoint zones that may still hold unfilled orders. Here's what we call our rule card. In summary, the guidelines we will consistently apply to identify zones throughout the course. Each part of a zone, the leg in, base, and leg out, comes with its own rule. The leg in. This is a price action leading right up to the base. It should feature either a decisive or an explosive candle, whether it's a rally or a drop, depending on the formation. The base. The base sits between the leg in and the leg out. It consists of 1 or more indecisive candles, marking the origin of the imbalance. This is where unfilled orders build up, creating the foundation of the zone. The leg out. The leg out must include at least 1 explosive candle. Remember, an explosive candle should satisfy 2 main criteria. Its body spans at least 70% of the candle's total range. It's noticeably larger than the previous candles. Shear size matters more than just the body to range ratio. An alternative for the leg out. Occasionally, you can have abnormally large decisive candles, followed by another decisive candle. This combination can also serve as a valid leg out. Keep in mind, these rules apply mostly to lower time frames. We will discuss in a future lesson how the zoning criteria might shift as you move up to higher time frames, especially for the leg out. By sticking to this structured approach, you will be able to pinpoint unfilled orders and reliably identify zones across different formations. It's completely normal to feel overwhelmed at this stage. Don't worry. These concepts become much clearer with practice. The more time you spend working on charts, the easier it will be to categorize candles and spot high-quality zones. In time, it will start to feel like second nature. The reality often isn't as clear as the theory, which makes it easy to misinterpret candles when examining them in isolation. Take example 1. For instance, the candle highlighted in yellow could be considered decisive or even explosive based on its body occupying 100% of its total range. But if you compare it to the surrounding candles, you will notice its overall range is actually quite small. This means it behaves more like an indecisive candle in practice. In a similar way, the red candle to the right might appear decisive due to its body to range ratio. Yet, its size is fairly modest compared to nearby candles, again placing it closer to indecisive territory. Looking at example 2, you can see how one decisive candle appears quite small. making it more of a basing candle rather than a leg out, while another is significantly larger than previous candles, potentially qualifying it as explosive. Always keep the context of surrounding candles in mind. Theory may give you a quick classification, but reality requires comparing each candle size and wicks with those around it to determine whether it's truly decisive or explosive. Now that you have learned how to properly identify supply and demand zones, your next step is to accurately mark them on your charts. To do this effectively, it's important to understand exactly where and how to place the lines that define these zones. Let's walk through the process of marking the so-called proximal and distal lines to ensure you're setting your charts up correctly. Notice on this chart, there's a demand zone below the current price and a supply zone above it. Each zone is outlined by two horizontal lines surrounding the base. The distal line lies furthest from the current price, and the proximal line sits closest to it. Mastering these line placements is crucial for accurate trading, as your entry and stop loss orders depend on them. Let's apply this concept to our demand zone formations, starting with a drop base rally setup. There are actually two ways to position the distal and proximal lines. The first method, sometimes called the wider version, place the proximal line at the highest wick and the distal line at the lowest wick of the entire formation. The second method, which we prefer for its precision, puts the proximal line at the highest body while still keeping the distal line at the lowest wick, even if the base includes multiple candles. We call it the preferred version. As a general rule of thumb for demand zones, the distal line always stays at the lowest wick. The proximal line shifts from the highest body to the highest wick when switching from preferred to the wider version. Following this consistent approach helps ensure accuracy when marking your supply and demand zones. At this example, we are looking at the second demand formation, the rally base rally. Just like before, there's a wider version and a preferred version for placing the proximal and distal lines. In the wider version, you'd place a proximal line at the highest wick and the distal line at the lowest wick found in the base. The preferred approach, however, lowers the proximal line to the highest body while keeping the distal line at the lowest wick. This remains true even if the base is made up of multiple candles. When it comes to supply zones, we use the same framework but in reverse. Here's a rally-based drop formation as an example. The distal line always goes at the highest wick of the entire formation. For the proximal line, you can choose a wider zone by placing it at the lowest wick, or opt for greater precision by positioning it at the lowest body. As you can see, it's essentially the same method we use for demand zones, just flipped on its head. Finally, let's talk about the drop-base drop supply formation. Once again, there are two versions, and the key difference lies in how we position the proximal line. In the wider version, the proximal line is placed at the lowest wick of the basing candle. In the preferred version, it's placed at the lowest body of those candles. Meanwhile, the distal line always goes at the highest wick of the basing candles, including the leg out. Now, this is where the fun begins, because we are ready to start drawing our zones. We follow a 4-step process to identify and mark them. First, we find the leg out, then the leg in, and finally the base. Technically, steps 2 and 3 can be viewed as one combined step, but I will show you exactly how to handle it all on the price chart in just a moment. Now, open your Campus Fund trading platform so you can follow along. These are the steps to identifying a supply zone. Find the current price. First, locate the current price on your chart. Then, move up and to the left until you spot an explosive candle, one that shows a strong move and doesn't overlap any previous candles. Highlight the leg out. Once you have found that explosive candle, mark its path with a vertical line. This segment is your leg out, showing where price quickly moved away from the area. Identify the leg in. Next, look for the leg in. This will typically be a decisive or explosive candle, something indicating a clear directional move into the zone. Mark that as well with another vertical line. Find the base. Finally, identify the base. Here, you will look for indecisive candles, the small-bodied ones that reveal hesitation or consolidation before the strong move occurred. By following these steps, locating the leg out, the leg in, and then the base, you will be able to pinpoint exactly where supply zones form on your chart. Give it a try, and you will see how much clearer your market analysis becomes once your zones are laid out properly. Let's head over to the charts on Campus Fund and do the process together directly on the charts. Welcome traders to my practical application about line placement. Today I will talk about the proximal line, the distal line, the preferred version and the wider version. Let's go into the charts. And here you can see our Campus Fund trading platform. We can analyze and execute all of our trades. You can see it is TradingView, right? Okay, I prepared already an example. Here that's a S&P 500 on the daily time frame. And we will start with the supply formations. And you can see there's a rally, a base, and a drop, right? An inverted U shape here. We have always two lines and two versions. We will start with a proximal line, okay? The proximal line on this formation here, we have to place a proximal line to the lowest body of the base candle and the distal line on the highest wick of the entire formation. Leg in, base, and leg out. Okay, and that is here. Let me zoom in a little bit. And by the way, like this is this with a proximal line. Here is our preferred version. Okay, we have another version that is a wider version. Look, I will always move the proximal line, never the distal line. And now the proximal line is to move to the lowest wick of the base candle. You can see that's a difference, right? Preferred version, lowest body of the wick, wider version, lowest wick of the base candle. Great. Of course, we have also different opportunities to getting filled and risk to reward ratio. I will explain you this here in this example. The proximal line presents always our entry. The distal, we will move our stop loss above the distal. Great. Let me add the short position tool here, okay? We will go with the first. Second, I will set the target just here, okay? That's not a proper target, but it's just for this example. Let's see the wider version setup, okay? Let me do the same. Let me do the same for the preferred version. I will change the line. Right, that is preferred. I will go with the yellow, okay? Yellow is the preferred version of the rally-based drop. And the distal is always the same. Here, that's a wider version. And that means I have to move my entry all the way up to the preferred proximal line. First, please compare the risk to reward ratio. Left, right, the wider version, risk to reward ratio 3. On the right side, the preferred version and the risk to reward ratio 12. That is a difference, right? You can see you can maximize definitely your profit margin with a preferred version. But what's about the probability to getting filled? Your entry, right, the wider version is more close to the current price and compare the entry with the preferred version, you can see the entry is far away, right? All the way up. Probability to getting filled is really nice on the wider version, less on the preferred version. Okay, let's check. I'll press the play button, then we will see how this one plays out. Oh, wow. Look at this. You can see we hit the wider version and then immediately a new low. That's great, right? We made here, by the way, more than 3 Rs. Look, the price dropped all the way down. But we never hit the second version, means the preferred version. And here, guys, I think you will understand the probability to getting filled, right? And your risk to reward ratio. Here, that's definitely the best choice, the best decision to take the wider version instead of the preferred version. Great. It was our first example for the rally base drop. We have another example for the second supply zone. And look at this. Here we have a drop. We have a drop, a base, 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 and another drop, right? Perfect. That is a supply zone. Here, I will also add the proximal and distal line for you. Again, we have 2 lines. We will start always with a proximal line. And for the preferred version, okay, we will place the proximal line on the lowest body of the base candles. Okay, that is here. And the distal line on the highest wick of the base candle or leg out candle, whatever it's higher. Look, this one is the preferred version of the drop, base, drop, preferred. And for the wider version, we have only to move the proximal line, right? Never the distal line. And for the wider version, we have to move the proximal line on the lowest wick of the base candles. Great. Here, guys, it is the same, right? I will add again the horizontal ray. You can see the white line is a proximal line for the wider version, and the yellow line is a proximal line for the preferred version. Probability to getting filled and risk to reward ratio, we talked already about it. Great. We are done with both formations, both supply formations. Now we have to talk about the demand formations. Okay, here I prepared already an example again, and that is a Dow Jones on the weekly time frame. We are looking for a demand formation, and here look, a drop, base, rally. That is a U shape, right? And again, we will start with a proximal line and then distal line. Proximal line on the highest body of the base candle and the distal on the lowest wick of the entire formation. Leg in, base, or leg out. And in this case, it is the leg out. It's the lowest wick. You can see that here. That is a preferred version, right? And the wider version, we will never move the distal line, only the proximal line. Here we have just to move the proximal line on the highest wick of the base candle. I will add again the yellow line for the preferred version. Right here you can see the difference. Let's look how this one plays out. I'll press the play button and waiting. Now we hit the level on wider, not preferred. Look at this. Oh, great. Look, this is a different example. Remember on the first supply example, there we hit only the wider version, never the preferred. And here, yes, we hit first the wider version. We filled institutional unfilled buying orders. That's the reason why we got the reaction here, right? And then in the next step, come back again, a pullback also on the preferred version, filled more and more institutional buying orders, and then look at this move. That's amazing, right? Here you can see also the difference again between probability to getting filled. In this case, okay, you would getting filled both with a preferred and wider version, but to increase your risk to reward ratio, the best decision is here to go with a preferred version. Great. Last but not least, we have one more demand formation. Okay, I prepared another example for our last demand formation. Okay, here we have to looking for rally, base rally. And look at this. There's a nice explosive leg in, 3 indecisive base candles, and a nice leg out. Look, all the movement to the upside. Amazing. Okay, now we have to place our proximal and distal line. We'll start with the proximal line and the preferred version again, meaning we have to place our proximal line on the highest body of the base candle and the distal line on the lowest wick of the base candle. And that is here, including the leg out candle. This one, right? But in this case, the base candle is the lowest wick. Great. This one is our preferred version, and the wider. Again, we will never move our distal, only the proximal line, and we will move the proximal line to the highest wick of the base candles. This is our wider, and here again our preferred version. Great. Let's press the play button. We'll wait, getting filled, getting weakness, and we hit the zone. And look at this. More strength, maybe a retest. Okay, I think that's more than enough. Oh, wow. Look, that's really nice. Here we tested, or we hit also the preferred version, right? Here it's not a difference for the probability to getting filled. It's the same for wider and preferred, but to increase your profit margin, then definitely the preferred version is or was the best decision in this case. Okay, that was my practical application about line placement. We talked about the different entry opportunities, means wider version or preferred version, how to place the proximal line and the distal line. Thank you very much. See you in the next practical application. Congratulations on completing another lesson. I know there's a lot to unpack here, and it may take some practice before you feel comfortable identifying zones. That's why we offer our zoning process practical application session, where a mentor walks you through everything live each week. You can find the next session by checking the calendar on the OTC website. If you can't attend, don't worry. Every session is recorded, so you can watch whenever it suits you. I'm excited to see you in our next lesson, where we'll dive deeper into the analysis process and discuss timeframes. See you there.